welcome to the podcast, Stu.
Hey, thanks, Kevin.
So I think it's your first time on the podcast. Do I have that right?
That is long time, first time.
Fantastic. So we're doing the quarterly today. Between you and I, we'll cover kind of the big macro themes, rates, credit, of course, equities, and then asset mix. Why don't we start with you to set the stage? Big picture, global economy. When you look at kind of sort of Q4 macro data, whether it be growth, inflation, the labor market in particular, what stood out to you? How did that backdrop affect the opportunity set for investors?
Yeah, no, thanks, Kevin. So, big picture stuff. Q4, we saw an ongoing mix of modest growth, softer labor conditions, easing inflation. The US economy stayed in a resilient but slowing mode. Capital spending was held up thanks to AI related investments and fiscal spending, but housing and hiring stayed a little weaker. The Fed's beige book description of flat activity during the quarter, I think, captured the tone pretty well. One thing that stood out to me, continues to, with just how much fiscal support remains in the system is government spending continues and debt keeps accumulating well past the COVID period now. It's not just the US. We saw continued stimulus out of most G7 countries, Germany relaxing its fiscal brake, Canada's infrastructure heavy budget. Most recently, we've seen Japan also leaning more supportive. Here in Canada, bringing it back to growth, third quarter, strong headline GDP, 2.6% annualized, masked some of the underlying weakness. Data during the quarter did show softer domestic demand, weaker consumption, declining business investment. On the inflation front, globally, inflation seems to have been evolving as central banks expected, still above target in some economies, but drifting lower, especially as energy prices has cooled as we exited the year and services inflation has eased as well. On the labor front in North America, the market softened but hasn't cracked. The US showed slower job growth and a modest rise in unemployment into December. While in Canada here, the latest labor force survey showed a rising unemployment, muted hiring, despite a few strong monthly prints. So getting back to your question about the opportunity set, I think against that backdrop, we certainly did see global equity markets had another strong quarter. Tariffs, geopolitical events, and no doubt some of the continuation of, of the AI trade or doubts about that benefited some non-US markets. Easier global policy also supported equities. Canadian stocks had a solid finish to the year, helped by strength in the metals and mining and good results from the Canadian financials. And if I think about the fourth quarter in 2025, the results from the economy and the markets seem to at times move in different schedules. And it's always a good reminder that markets do trade on expectations on policy earnings and sentiment often before the data confirms it. So that's a big macro picture as I saw it. A steady to declining inflation, good activity or decent activity, markets already looking forward. But of course, none of that happens in isolation. And central banks were a big part of that story in Q4. So Kevin, how did the markets and central banks respond to that evolving mix of growth and inflation? And what did we see in terms of bond market performance?
Yeah, I would say for the quarter as well as kind of 2025 overall, the key story for bond investors was really, and central banks particularly, was really around the move of central banks from how restrictive to how to normalize. We saw a lot of cutting throughout the year. Markets responded pretty favorably to that. I guess starting in the US, you've got the Fed that cut three times in 2025, two times in the quarter, so both October and December meetings. That brought the Fed funds rate down to 3.5 to 3.75. Those decisions were not unanimous, though. If you look at the December decision, the Fed vote was 9-3 in favor of a cut, which does indicate that, to your point earlier, that there is still some debate around inflation, whether core inflation remains above target. And so there are some dissenting voices as to whether that we should really be in cutting cycle. But that 3 to 3.5 is still in restricted level, still in restricted range. So I think that was sort of the key rationale for why you got the cuts. The direction of travel does appear to be pretty clear in terms of lower rates from the Fed. You've got, as you mentioned before, soft labor market, job openings, and quit rates kind of back to the 2021 levels. That's really tilted the risk balance in favor of further easing, notwithstanding what we've seen since the end of the quarter with Jerome Powell and President Trump and all of that sort of noise. The direction of travel, certainly, if it was in Mr. Trump's purview, would be to cut further. Even notwithstanding that, though, I think there's still reasons for the Fed to be in easing mode. In Canada, you've got the Bank of Canada that moved 25 basis points in the quarter. Recall that the Bank of Canada has already been cutting. They started earlier and they've been cutting more aggressively. So that brought the overnight rate to 2.25. So unlike the Fed, they are already in pretty accommodative territory, the lower end of the range that the central bank targets. And then financial conditions have already kind of got back to those early 2020 levels. But you do have big uncertainties around, of course, US trade and USMCA, which is due for renewal. And so the Bank of Canada has signaled that they are happy and comfortable with the pause. They think the policy levels are about right, but you could certainly see further cuts if there were to continue to be weaker data or some of these trade negotiations take a turn for the worse. In terms of bond market reaction, policy shifts have affected the curve quite a bit, both particularly over the year. In both Canada and the US, you got the front end rallying, short policy rates falling, and that affecting short bond prices with longer yields moving less. And so as a result, you've got a steeper yield curve over the course of the year. For our strategies, that was favorable, as our Canadian bond strategy was in a steepener position, meaning it would do well if longer yields underperform relative to the short end. So that's been good for the strategy. And then lastly, in Canada, at the index level, you did see, though, in the quarter a little bit of negative returns. And that's really a function of that 10-year part of the curve in particular, where we saw yields move from about 3.2 to roughly 3.4. So a little bit of pressure there on prices, even though you did see the steepener overall for the year. But overall, that sort of led to okay results in the quarter, and it was reasonable results for the year as well. Credit was another theme that did quite well. And actually, speaking of credit, how would you say the both investment grade and high yield markets behaved in Q4, both in terms of spreads and any color on issuance? And where do we kind of see the balance of risk and reward in corporate bonds as we sort of head into the new year?
Yeah, so, Q4, we saw global investment grade and high yield credit post positive returns. Most of that was derived from coupon income rather than spread tightening, as spreads were broadly stable throughout most of the quarter. On the issuance side, activity did pick up. US investment grade supply running higher than last year. A big driver there was tech related borrowing from most of the hyperscalers or Amazon, Google, Meta, and also Oracle, who tapped the market to fund AI infrastructure. We also saw some issuance in financials and utilities. Looking ahead, tech-related financing likely is still a dominant theme in credit markets into 2026 as demand for AI and data infrastructure still grows. That could put some modest upward pressure on spreads, which, again, worth noting, are still sitting at multi-decade lows. So the balance in credit markets today is still favoring borrowers over lenders. So, if growth does hold up, credit may continue to fund the AI spending, potentially pick up in corporate M&A as well. But we're cautious on how long that equilibrium does last. So, I guess the message to investors heading into 2026 remains much as it was in 2025, which is resist the urge to reach for yield, means going whether that means going down in quality, out in duration, or into less liquid markets. We can't time the turn in spreads, as we know, but we do believe it will come. And the right playbook is really to plan ahead. So protect capital now and be ready to deploy when that next credit dislocation inevitably presents itself. So that's where we are in credit. Turning it back to you, Kevin, thinking about on the equity side, much of the story last year was dominated by that handful of mega cap growth names. So, are we still seeing that concentration carry markets, or did leadership kind of finally start to broaden out in the fourth quarter?
I would say more the latter. It did start broadening out. AI was still a very dominant narrative, but as you mentioned kind of off the top, the global equity markets, Headline level, another strong quarter. But I think what shifted a little bit is who led. So you've got investors at the margin starting to rotate away from that kind of narrow group of US sort of mega cap AI winners. They still did, some of them did okay, some of them not so much in the quarter. Very strong years though overall, but there was a bit of a pullback in some of the hyperscalers. So companies like Microsoft, for example, which had driven a lot of the prior advance throughout the year. And you did see a bit of a rotation into other areas that are more cyclical, whether it be small caps and also some rate sensitive areas of the market. You mentioned earlier about banks, so that would be a good example of where we did see a rotation into. So we did see a bit of a broadening. Canadian equities specifically, they outperformed the US. That was led largely by commodities, particularly gold. That's been a dominant theme in the market for a little while now. So no change there necessarily, but European markets also did quite well, substantially outpaced the US. They've got bank, fairly large banking exposure, which helped just with the yield curve. And then there's also some commodity exposure there as well that did quite well. On the AI front, the conversation I would say has shifted. Uh, you've got earlier in the year, the focus was really on computing power and model leadership, so the actual LLMs. By Q4, you had a lot more attention, and this had already started earlier in the year, but I think it was much more pronounced in the quarter. A lot more attention on data center profitability, power supply constraints, the sheer scale of the capex required. You talked a little bit about this actually in the credit section, that there's a lot of credit being taken out by these hyperscalers, and in some ways you can't blame them. The credit's pretty cheap right now, and so it might end up being a good return on investment for them. Maybe not. We'll see, but certainly the financing has been quite attractive, and that's all of that sort of collectively has raised more explicit concerns around talks of bubbles, parallels that have been drawn to previous technology booms. Whether you go back to the railroads or something more recent like .com, there are some similarities, whether it be easy credit, increasing leverage, even retail participation, certainly stretched valuations, and the just general concern about a correction in a lot of those sort of pockets of the market. But there is sort of a nuanced view, I would say, when it comes to AI specifically. So I would say what you did see in the quarter, which was a bit of a bifurcation, is really AI enablers continued to do well. So these would be things like high bandwidth memory. So like a South Korean company called SK Hynix, TSMC, the world's largest by far semiconductor manufacturer, Kingslide, Hitachi that does power. They've all continued to benefit from the explosive growth that you've seen on AI related infrastructure. And so they've continued to win. But some of those hyperscalers that I alluded to earlier did pull back a little bit after a pretty strong run. And then even in the Canadian context, you have a couple of examples like software compounders like Constellation and Topicus that did have been facing questions around would AI disrupt some of their core offerings. So yeah, I guess to bring it all together, to answer your question directly, AI was actually still a key driver of equity markets in the quarter, but it wasn't the only driver. We did see some other parts of the market that have done quite well, which I think overall is quite constructive. If you're a long-term active investor, you want to see a little bit more breadth and diversification as opposed to a very narrow part of the market, which, if you want to stay diversified, it's tough to be, arguably you would be over allocated if you're really focused on what's won over the last couple of years. And so as we see some of that broadening out, I think that's a healthy adjustment. As far as maybe I got a question for you that actually relates to something that happened slightly past the end of the quarter, but I think it's such a big topic that it'd be remiss if we were to miss it. Um, and that really relates to what we saw in the past week or so in Venezuela. U.S. intervention there has really caught the market's attention. Just curious on your views and the team's views on sort of the developments that have happened there. I know it's early, so it's difficult to sort of get a read on this, but at least initial thoughts of what's happened there, and particularly how it might impact the oil markets globally, and just the broader energy complex sort of risks opportunities that we're seeing at least at this early stage.
Yeah, it's never a dull moment in the world and markets, is it, Kevin? It's There's always something. So US intervention in Venezuela, as you said, grabbed markets' attention, but at this stage, it looks more like the start of what could be a long or untidy geopolitical saga than any immediate shock to global supply. Venezuela is still a relatively small producer today compared to its historical potential or output. The oil market also came out of last year in a surplus. So the initial move in crude has been modest. We did see gold and silver actually react more sharply to the news as people reach for those geopolitical type of hedges. For Canadian investors, I think that the important angle here is the medium to long term path. If Venezuela actually manages to bring meaningful supply back to the market, if US technology and capital does unlock that significant additional Venezuelan production over many years, along growth that's already happening in heavy and medium crudes in Guyana, Brazil, and Argentina, you could see that Western Hemisphere may become that more dominant oversupplied basin, putting a structural pressure potentially on Canadian crude oil as those all those barrels compete into the US Gulf Coast refiners. If you step back, Venezuela looks potentially less like a one off headline, more part of a broader shift towards this transactional spheres of influence type of world. We've moved away from, or moving away from, a post war era of globalization and this soft power towards something maybe closer to modern mercantilism, where the powers are spheres of influence are working hard to lock down those secure access to energy and critical minerals. So in that context, maybe moves like this are really about securing supply lines, but getting from here to there, or eventually, if it does happen, is likely more volatility ahead, more policy intervention, more headline risk. And I think that's exactly the type of environment where remaining disciplined, diversified, and a valuation driven approach matters more than ever. So, as you said, early days, there's a lot to unpack there. It really does show, I think, how interconnected geopolitics and markets have become. So, if we step back then from all of this, Kevin, over to you to think about asset mix today. So between equities, bonds, and cash, given everything we've talked about with policy, credit, AI, and energy, how are you thinking about that asset mix today?
Yeah, so I would say the focus has really been on at the margin. These aren't large adjustments, but I would say at the margin, we have trimmed our equities in favor of bonds, a mix of cash, core bonds, as well as global credit. And really, the rationale there was, as we've talked about kind of throughout the year, valuations have been quite elevated. The markets have obviously done quite well throughout the year, so they've continued to push higher from a valuation point of view, and we've trimmed into that strength. So we continued doing that in the quarter. Again, not a huge adjustment, but nevertheless, Uh, we did make a small trim within equities specifically. We did make a few sort of shifts under the hood. We trimmed a little bit of Canadian small cap in favor of large cap, and that's really sort of consistent with a view that we've had for a while now, which is the opportunity set in the large cap space is quite a bit more attractive than in small cap. You've just seen a lot of companies taken private, not as many IPOs in the Canadian small cap space. Still opportunity there, but just at the margin, we think that the greater breadth that you get from the large cap space in Canada is quite attractive. And then also, we've actually increased our exposure to the US markets, sourced from emerging markets. So if you kind of recall, and actually to a lesser extent, also sourced a little bit from international as well, but emerging market being the bigger one. If you kind of recall over the last 12 to 18 months, we'd actually made the opposite move. We were moving out of trimming the US at the margin, partly a valuation story, in favor of international and EM. Those markets have outperformed in 2025, so it was a good adjustment with the benefit of hindsight. But as those markets' relative valuations have moved, we're now taking the opportunity to reverse a little bit of that trade, peel back a little bit of that international exposure, and then add it back to the US. And then I mentioned off the top that we trimmed equities, of course, and we put it into fixed income. And the logic really there, besides sort of the rationale I've already given as to why we're trimming equities, but sort of the case for fixed income is really we still think the asset class generally remains pretty appealing. If you think about what I mentioned earlier about global central banks pivoting towards easing, longer yields, what they're still actually relatively elevated by historical standards. If you think about that zero interest rate policy that we were in for many years. We're out of that, even though rates are coming down. There's the starting yields are still decent. And you mentioned during the macro section that we are starting to see, whether it be labor data or so some of the other macro data, that there is a bit of a slowdown in the economy, and all else equal, that it's helpful to have a little bit more bonds then, in that if you do get a risk off scenario. So hence the shift out of equities into fixed income. So having said all that, I mean, the balance strategy overall is sitting not too far off neutral, which we think does sort of, again, reflect that rising valuation concerns and lingering questions really about the state of the economy. And so all else equal, we think sort of a neutral posture is warranted at this point. So that's all I've got. I don't know if you want to talk about anything else, but I think this was a great first conversation. Looking forward to more in the future.
For sure. Thanks for having me.